The US midterm election results have brought in the needed checks and balance in US polity, with Democrats seizing the control of House of Representatives, even though Republicans maintained their control over Senate. Let's do a three-point analysis on what does this mean for businesses, economy, and the markets. 1. What has Trump government achieved so far? Well, the 2 years of Trump's tenure is a period marked by broad-based growth phase for the US economy, wherein central bank had quickened its pace of interest rate normalization. Now, administration's stance on outsourcing, deregulation and emphasis on domestic investment have had a positive impact on the kinds of jobs opening in the labor market. Mining and oil and gas have been amongst those sectors benefiting as well. Fiscal stimulus is an important lever which in turn can boost higher GDP growth through personal consumption and corporate investment. Trump government had lowered corporate taxes as well to 21% from 35% and provided income tax relief till 2025. Tax cut benefit has already translated to higher earnings growth for US corporates. S&P 500 earning growth expectations in the current quarterly results is also about 25% year-on-year. Further, Trump has also been focusing on lower trade deficit and hence targeting improving net exports. Implicit in this is also to get the jobs back lost to globalization and outsourcing. Government is making efforts to protect US technological prowess that is coming under threat due to China's endeavor to leapfrog in the high technology areas. However, higher import tariffs are distorting the manufacturing supply chains, and an adverse impact on the downstream industries remains a concern as well. 2. Given the current context of the US midterm elections, how should one read financial markets' reaction? Well, while most of the economic parameters have improved during Trump's tenure so far, various periphery risks also have emerged during the course. Trade diplomacy is a key factor behind moderation in global growth expectation. Further, Trump's not-so-palatable stance on immigration, outsourcing, globalization, and an apparent favoritism for certain segments of people have had weighed on his approval ratings as well. Stock market reaction to midterm results have also been well anticipated. Equity led by technology and healthcare stocks have also rallied. US dollars and bond yield initially eased but now are firming up. Clearly, consequences to the expectations was not priced in the market, as well as possibilities for extreme situations were also there when one of the parties sweeps both the chambers. In case of Democrats, it would have meant a higher possibility of gridlock situation between executive and legislature, and in case of Republicans, it would have emboldened Trump in his global trade diplomacy. 3. So is the bipartisanship better, and what next? Apparently so. It brings back the legislative checks and balance and also potentially reduces the downside risk from trade diplomacy. It can also do some course correction or offer options in contentious areas such as immigration policies for IT and healthcare reforms. And on the flip side, few situations of stalemate can arise, including debt ceiling and sequester relief as well. Congressional investigations cannot be ruled out as well with respect to various executive actions. Now, with political uncertainty out of the way, markets are expected to focus its attention back on monetary policy and corporate earnings. While Q3 earnings season has been strong, Fed's November meeting signals a December rate hike. On the trade war front, however, Trump and Xi Jinping meet on 30th of November at the G20 summit assumes importance now. And on the whole, midterm results should provide downside protection from the policy risk emerging from executive actions.